Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Hello, and welcome to the Liquidity Event. We're your hosts, AJ.
And I'm in the mic, Shane Mason.
And this is episode 132, being recorded on January 21st, 2025, airing on January 24th. A quick reminder for your listeners, we will answer your questions on the pod if you leave us a message. You can disguise your voice and use a fake name if you're shy. The link is memo.fm/the liquidity event. Today, we are talking all things RSUs or restricted stock units or really swell underpants, understanding the tax implications, deciding when to sell, and how to avoid common pitfalls that could cost you thousands in unexpected taxes and lost gains. How you doing today, Shane Mason?
I'm good. Everything's relative, right? I had 102 fever over the weekend, so feeling normal is feeling great today, AJ.
Oh, you're like, you can breathe and see straight? Like 10 out of 10 day.
So one of the best things, yes. Well, I don't know. I kind of like being sick. I mean, obviously it feels terrible, but you get to catch up on all those Oscar nominees that you've been
I literally been waiting to get sick so I can watch Severance. I'm so behind on Severance.
You can just barely see the mattress I put in the living room right in front of the TV right here for my 3-day bender of chicken noodle soup and Apple TV.
Did you watch anything worth highlighting on this here podcast?
I like really deep cut horror movies that nobody likes, but I watched one called Mads, which was the first movie I'd ever seen. It came out in 24 or 23, all shot in one take. It was like an hour and a half, and it just follows character after character in one long take. And it's genuinely scary, genuinely interesting, well done. And it's like a zombie movie. It was really cool. Got to recommend it for the horror heads out there.
Cool. Anything for us non-horror heads that you liked?
I watched the beginning of the McConaissance movie Mud, where Matthew McConaughey is on the lam on a Mississippi River island off the coast in between Arkansas and Mississippi, which was really great. He looked great. Yeah.
What is the McConaissance? Is that 2024 or is that like a couple years ago?
No, it was like 2013 to 2019.
Okay.
That was like Dallas Buyers Club.
Oh, got it.
Mud.
Okay.
I don't remember what else off the top of my head right now, but it's after he comes out of the journey or failure to launch and how to
when he became a serious actor and got out of the rom-com, got out of like, I'm just like a hot boy who's going to star, opposite Sarah Jessica Parker or
True Detective season 1 was the pinnacle of the McConaissance. Yes.
Yes. I remember the days. remember when it was like tax season, that had to be like 2019, 2020, where you and I were just like at the WeWork 24/7, and I had this great photo of you, and this is like right when True Detective came out.
Oh no, don't.
And
no.
you look. It's a compliment because I'm comparing you to Matthew McConaughey, but it's True Detective Matthew McConaughey. It's not failure to launch.
Not only True Detective Matthew McConaughey, but the post-retirement.
Yes, the reciting the flashbacks, Matthew McConaughey.
He drinks a 6-pack of Tall Boys in about 2 hours while being interviewed and rips a whole pack of cigarettes. McConaughey. Yes.
Incredible. Just quick check-in. Where are you in the world?
Mexico City. And I got to say, one of the best things about being down here, healthcare-wise, you just ring up a doctor. They come to your house with the medications. They take your temperature. They get the antibiotics. It all comes straight to the house. So I was laying in this bed, and I'm not going to lie, attractive mid-30s female doctor laid down, came to my house, walked in, pet the dog, took my temperature, gave me a shot of steroids in the ass, dear listener, and then WhatsApped me the next day and said, "How are we feeling?"
When's the wedding?
So we're working on that. Trying to figure out what
only
her
Shane Mason, you guys.
hobbies.
Only Shane Mason. Incredible.
Fun weekend.
Incredible. Well, that beats my personal story about my homeowner's insurance premium going up. So
no, let's hear it.
No, just I got an email from Farmers, my insurance carrier in California, and I was dreading opening the email, just knowing that my premium was going to go up like 30, 40%. It went up 88%.
It doubled.
It doubled from last year, which was annoying. So I don't know.
That's really brave in the age of Mangione, you know? That took you a second.
Yeah, I got there eventually. Yeah. Is it brave, or is it just, this was a, we're talking about less than $2,000 increase here. It's already an expensive policy because it's in California, and there's a bunch of riders on it for when friends such as yourself stay in my place. So just in case you burn it down, we're extra covered. So I'm paying extra for that premium. But that was a pretty ballsy increase, if you know what I mean.
Yeah. Well, I think it's lovely that just in time for millennials to start to be able to afford homes, the subsidies for insurance companies in Florida and California are starting to disappear. So yet again, the axe falls
on millennials.
Well, I'm not butthurt about it at all.
Let's talk about something positive that is impacting millennials. Today, as requested by our wonderful friends at our marketing firm, Craft Impact, shout out to them. We love them. They have suggested that instead of you and I just talking about bullshit that we read on the internet for 30 minutes, we should do these deep dive episodes. You and I have this unique knowledge set, one might say, about equity compensation. I would say it's pretty unique. I would say pretty unique. Unique New York.
Unique New York. That's AJ's warm up for the podcast, by the way, dear listener.
Unique New York. So equity compensation, right? We're talking about a lot of people who work in tech, biotech, really any public company or private company that has decided to issue ownership shares to their employees. That's what we're talking about today. And we're going to talk about RSUs, restricted stock units, or give me another RSU, radicalized salamanders uniting.
Really sick umbrella you have there, AJ.
There you go. Thank you.
I really like what you've done with it.
Thank you. RSU, babe. Okay, so let's play favorites for a second, Shane. What is your favorite type of equity compensation? We know what kind of type you like in your doctors. Tell me about your favorite type of equity compensation.
Well, the joke is I like them simple. And RSUs are the simplest of equity compensation. I must say, not much going on upstairs, so to speak. They're granted, they vest, full value awards.
I'm sorry I asked you guys. I'm sorry
There's no alternative minimum tax, no parallel universes, no ulterior motives, no, oh no, I don't want kids 2 years later. Come on. This whole time you've been grooming me. What are we talking about again?
RSUs.
Oh, right. Equity compensation. What about you?
I'm gonna go with ISOs. I like incentive stock options because I believe that if I make the right decisions, I can enact changes for the better for everybody. So going with your theme, I think that if we're armed with the right tools and enough time, I can have greater outcomes. So yes, I like incentive stock options the best, but we're talking about RSUs today. We got a ton of questions from readers, listeners, readers to our blog, listeners to this podcast, clients at the firm Brooklyn FI. I/John/ other marketing firms have written tons of content on our blog about RSUs. So basically we went and looked at all the stuff we've written over the years. I wrote some of this shit like 5 years ago. I don't remember writing it, but I'm sure I did at some point. And so basically
it says written by you on here.
It says written by me, and it sort of sounds like me. So we're going to just go through like the most common questions. So first question for you, I have, Shane. How are RSUs taxed when they vest versus when I sell them?
Great question. So equity compensation often reviewed or viewed as funny money or fun money, like not real part of your equity compensation or of your compensation package at a new company, unless you work at a company that leans so heavily into RSUs that it becomes over 40, 50, 60% of your compensation. A company like Amazon comes to mind, wherein it's had just such a high trajectory of stock growth over the past 10, 15, 20 years that it's almost like clockwork. Those RSUs are definitely worth something, and often worth more than when they were granted to you. A lot of people don't realize that this funny money is going to be actual income, and it's when on their tax return or in their paycheck when these RSUs vest. That's how it's taxed. When an RSU vests, not when it's granted, but when it vests. So when it is granted, that's definitely step one. That's usually your first day on the job. There's usually a waiting period of at least a year. We call that a cliff before any of the RSUs vest. And then typically we'll see 2, 3, 4 years of monthly or quarterly vesting after that 1 year cliff vest, so to speak. Then you'll have like more frequent vests because you made it through the first year of work here. You're kind of off your first year PIP. You're a part of the club. So, we're going to give you this equity compensation and a more routine basis. Okay, so not the grant, but when those items vest, they will be taxed. And the way that they are taxed is the amount of shares that will be vesting in that period will be multiplied times the fair market value.
The fair market value.
Sorry, my Mississippi popped out there for a second. Number of shares times the fair market value equals the amount of gross income. Which is just the
price, right? That's just the price of the stock. So if it's a publicly traded company, you Google the stock price, and usually it's the price at which it closes on that day, or it'll identify in the stock plan what price they're using. But if it's a private company, your company is going to report that. They're going to self-report it, which is fun.
Right. Yes. And it will be subject to ordinary income because in the United States, unlike some other countries, and when I say ordinary income, I mean ordinary income tax rates as opposed to capital gains tax rates, which, in America, we view equity compensation or RSUs as compensation for services, so to speak. So, you just show up for your job, you do your job. That's not really investment income. You're working labor-related job to receive that income, whereas capital gain income is typically seen as something from more of a passive or an investing type of activity. So when RSUs vest, they're subject to ordinary income tax rates as if it was just a salary.
Right. So it literally shows up on your paycheck, right? I mean, that's part of what we do is like we look at your paycheck, we make sure that the right amount gets reported on your paycheck. And at the end of the year, right now, I'm sure all of you are getting if you have a job where you have RSUs, you're getting those W-2s in the mail, or you got to go get them from your portal, and you're going to see that RSU number. Now, we, the Brooklyn FI equity compensation psychopaths, don't trust that number. We don't trust that number because that number is wrong so often, right? Like the first time I saw it was wrong, I was like, oh man, that company messed up. Like shame on that company for not having a good accounting department. But we've seen this over and over and over again. And this is not just at Joe Schmo's RSU generation, tire store. These are publicly traded companies that employ thousands of people. So PSA, check your W-2s, folks. Ask your CPA to double check them. But I mean, this question, the reason I think why people ask this question is because there's this misunderstanding in the ether about, you should wait to sell your RSUs. You should hold them past vesting and sell them because you get taxed at a lower rate, which is not a true statement, right? What you're saying, Shane, is that as soon as they vest, you're paying ordinary income tax no matter what. Ordinary. Why can't we talk today? You're paying tax on that income. It's showing up on your paycheck. Yeah, from that moment they vested, you pay taxes on it. Now you've recognized them. So now you have basis in it, which is cool. So if you sell them the next day for a huge gain because the stock price went up in one day, because who knows why, we have insider information, who knows, that little bit of gain, that is what you're going to get that preferential treatment of the lower capital gains rate. However, I just said the next day, which means that you did not hold them for a whole year. So you did not meet the minimum holding period, which is 365 days. So actually you would just end up paying ordinary income tax rates anyway. So the only way that you're able to get those lower capital gains rates, which are 0%, 15%, 20%, we add some more taxes on top of there. So it gets closer to more like 26, 27% when we have these big gains. But the only way you can get access to those lower rates is if you hold the stock for a whole year from the moment that it vests.
Yeah, I think to your point, a big part of the complication comes from, or the confusion comes from how complicated our income tax system is. First of all, we have ordinary income tax rates, which are different from capital gains rates. There's different brackets for each of those, there's brackets within each type of category. So like, a layman, a lot of people like to say, well, I just took, if they taught me taxes in high school instead of AP literature or whatever. Yeah, so geometry, you would have forgotten all this stuff anyway. It all would have changed anyway. So like,
I don't know. I still I hear you, but I do think that a simple 1 week course on taxes instead of parallelograms would have been helpful. I still remember some of those
than parallelograms. Yes, for sure. Well, I'm not friends with anyone in STEM, so me and all my friends, we definitely don't need the parallelogram.
You definitely don't need to parallelogram.
But like circling back to the confusion, I think that the interesting thing is that people are receiving stock, right? So they're like, this will be subject to capital gains, right? Because I'm receiving stock, right?
Totally.
But in reality, it's going to be subject to both. You're going to get, like you just said, when it vests and you get the stock, now you've received it. That's ordinary income tax experience right there. But then you hold the stock from that period forward. Now you're holding a stock. It's as if you just bought that stock. You've paid income taxes to buy a stock at the company that you work for, essentially.
All right.
And then you got to hold it for a year.
I got an analogy for you. Okay.
Oh, okay. That's right.
You familiar with Pocky, the Japanese snack?
I already see where you're going with this, and I love it.
The cracker. So for those not familiar, Pocky is a Japanese snack. It's a kind of wheat cracker. Think of like a saltine in the shape of a pencil, basically, and it's dipped in chocolate. So if you look at it, it looks like there's about 2 inches of cracker and then 6 inches of chocolate dipped cracker. So an RSU, when it vests, you are receiving that stock. So let's say that the stock price on that day is $2. So you're receiving 1 share of X of Pocky stock, and it's $2, right? So you're going to pay tax on that $2. That $2 was taxed at ordinary income rates. So I'm going to break off the little wafery part of the cracker. Now the remaining chocolate dipped part, you're going to hold on to that. You're not ready to sell it. You're going to hold on to it. You're going to put it in the back of your cabinet. It's going to sit there for 3 years, and you're going to sell it in 3 years, and you're going to sell that chocolatey part. And you've held it for more than 365 days. And guess what? Pocky's stock went up because you've been hoarding it. So now you're selling it for $4 a share. So that $2 increase from your $2 basis, that is going to be taxed at those preferential, chocolatey, delicious capital gains rates. What do you think?
I like a hot take on the I thought you were going to say...
Give me another Pocky analogy, please. I
like where your head's at, because we have 2 different types of treatment for one item. We've got the chocolatey candy piece and then like we've got the dry handheld piece. The way I thought you were going with it, honestly, was that the chocolate piece is like the original, it's like you have to hold that for a year for it to vest, and now you've just started on your vesting for the capital gains
I got you.
period.
Okay.
Which is that new little shrub that needs to grow. It goes either way.
Anyway.
Yeah.
So we understand that RSUs have basically 2 different portions of the way that they're taxed when they vest and when you sell them. And sometimes that can happen on the same day. So sometimes it can be sort of 2 separate transactions, but it's kind of treated as one transaction, which is very confusing. But that begs the question, should I sell my RSUs immediately? What are kind of the pros and cons of selling them right away or holding them for long term, longer than a year, or for a lot longer than that?
Yeah, I mean, I've got a couple things here I'd love to talk about. I mean, I know this is a huge topic of conversation for both you and I and all of our financial planners and tax people. I mean, that's pretty much why this firm exists. It got started because of some crazy incentive stock option questions we got as our tax practice, which evolved into the planning space. But the RSUs just make up so much more of the conversation. They take up so much more of the oxygen around how do we divest from these concentrated positions. And I think some of the most important things to consider is like how much of our whole portfolio is concentrated in this one company that we're working for right here. I don't need you to sell your stock in that company if it's only making up 10, 20, 30% of your portfolio, because maybe you're older, or maybe you've made money elsewhere, or maybe you've inherited money and you already have a diversified portfolio elsewhere. And this position that you have in your current company isn't isn't too concentrated, right? You've got other companies that can go up and down, and we're going to get that benefit of diversification. But if we're 90, 100, even anything really over 50, 60% concentrated in one company stock, I'm going to want you to take that free lunch of the increased returns you get by diversifying, which is a little bit counterintuitive for a lot of our clients when they come in the door, because there's this idea of they are rich now. That's why they're talking to us. Or I should say they're much richer than they used to be, and now they need a financial planner because of this concentrated position. This made them rich. So surely having this concentrated position will continue to make them richer, because stocks only go up and to the right. Right, AJ?
That's correct. Yeah. Well, I think it's also another way to put it is we can sit here all day and say diversify, diversify, diversify. What are the returns of a Brooklyn FI portfolio? And we say, well, they're diversified across the US stock market, mostly large cap, small cap, all the above, a little bit of international, a little bit of bonds. And they're going, well, my stock is Apple, so try and beat that. It's like, well, we can't. You're right. Last year, Apple did
down 5% on the year.
Ooh, I stand corrected.
Well, just this year. I mean,
this year. Okay. In 2025.
Tariffs, by the way, we're recording this the day after Trump was inaugurated. So we are skirting over a lot of topical news in today's episode. But if you're listening to this in 2025, 26, 27, that should be interesting.
I'm sure we will get to all of that in future episodes. I'm sure we will touch on the political implications of law changes, especially as they relate to markets and taxation.
But yes, over the last 10 years, Apple stock is probably up. We don't have it pulled up right now. Probably up 500-600%.
Yes, so, exactly. So exactly. Why would you want to why sell, right? Why not hold it for forever? Because it's going to keep going up when you might be able to have this massive payout in the future. I get that. I get that inclination. Yeah, another thing I like to do. Oh, go ahead.
Well, I mean, to your point about Apple RSUs and should we sell those, my next item on this list here is the maturity of the company that you're working at. Because what we've seen typically is that more mature companies are more stable. I don't think that is irregular to say. And if we have seen a lot of these tech companies that have only been around 7, 8, 9 years. They have meteoric rises, but they also have meteoric falls. Like Blue Apron would probably want to be the most iconic example of a company that has lost over 99% of its value within a time frame of just a few years of going public.
For sure. Yeah. One thing I like to do with our clients is also just decide at the outset on a legacy position. Like, yeah, I'm at Apple. I want to hold, whether it's a percentage or a dollar amount, like at the beginning, when you get hired at that first vest, like, yeah, I want to hold 20% of my original grant in Apple long term. I want to pass it on to my kids, or I want to hold it for 50 years. Great. We'll always have that in mind, so we can hold back 20% of your holdings. We're not going to sell those as part of our regular diversification plan. Shane, I'm going to keep us moving because we got a lot of questions to get to. Cool. Let's talk about withholding, because I feel like this is why a lot of beleaguered folks show up on Brooklyn FI's doorstep and they say, my accountant messed up. I owed so much money in taxes last year. Can you please help me? And they've got one paycheck and a bunch of RSUs. Shane, what has happened? Was it the accountant's fault? What has happened with their RSUs?
Well, something we skirted over earlier is that, yes, the stock has vested and we've paid income taxes on that. But we actually haven't received any cash like you would with your paycheck, right? You have received something of value, though. You've received stock, right? And it's in a brokerage account. It's usually at like an E-Trade or a Merrill or bank, wherever, or Fidelity, wherever your company decides to custodian its equity compensation. But what else is going on is that because withholding is required in the United States as a pay-as-you-go system, then there needs to be some sort of payment of your income taxes related to that income that you've received of compensation for services. So typically what we'll see is a company will opt into a standardized 22%. It's actually the default. They don't opt into it. According to the U.S. Treasury, you need to withhold on quote unquote supplemental income at 22% flat rate on any bonuses, and equity compensation falls within this category of supplemental income. So we've got people that are some of the highest achievers in the country working at companies that value them so highly that they're going to give them equity in the company that they're working at, because they get the idea of the harder they work, then the more money everyone's going to make, or all rowing in the same direction. Really high achievers which are typically in a much higher tax bracket. So you want to talk to us about the problem with withholding at 22% of our income? when we're some of the highest achievers in the country?
Right. So basically what's happening is that person, their accountant didn't do anything wrong. They were just withholding at the statutory rate when they needed to be withholding at the top rate, or 35%. Actually, if your paycheck shows that you made more than $1 million that one paycheck, we can kick up that statutory withholding. And some companies will let you withhold more. So that's certainly a conversation you want to have not a conversation. You probably just go into your platform and just increase your withholding if you're worried about owing extra taxes when you've got RSUs. Can we talk about double trigger RSUs for a second? Because we're seeing these a lot more. Double trigger, meaning that you work at a private company to which there is no public market that you can sell your shares on. What are you laughing about?
I just don't know why I hate this word so much. I feel like it creates so much
double
confusion.
Trigger. Yeah, it is very confusing. It is very confusing, but all it means is, actually, it means many different things because there's a lot of different types of double trigger and nuances to it. But effectively what it means is your company's private. There's not a public market where you can sell these options, and the company can't sell them either. So as you are vesting these shares, instead of actually receiving the shares and paying taxes on them, you're still vesting, but no actual changing hands of money takes place. So this way you're able to receive shares. The company doesn't have to do any withholding for you. You don't have to do any withholding, and you can continue to receive them while the company remains private. Now, there's all these rules around this. So all of this like RSU, all this equity compensation, a lot of the rules that govern this space are in this rule called the 409A rules. And there's a million different rules subject to a bunch of interpretations. But one of them is that these companies that issue double trigger RSUs have to, at some point, go public. They basically start a clock once the RSUs are granted. You've got 7 years to go public, folks. And most recently, we had this really high-profile case of Stripe, a company that had issued hundreds of thousands of dollars or millions of dollars of RSUs, and their clock ran out, Shane. So they actually had to have a liquidity event. They had a tender offer with their employees.
Froze their eggs.
Exactly. Yes, they should have frozen their eggs. Oh, God.
That was for you.
Thank you. I'm going to send me on a... Anyway. I know you... Oh, God.
Dear listener.
Anyways, you
really
really threw me off
audience.
there. Yeah. So Stripe ran out of time. They had to do a tender offer. They offered liquidity to their employees. So that was the way they skirted this 7-year rule. Otherwise, all the RSUs would have been forfeited, and they likely would have been sued by all their employees in a devastating class action suit. Would have been the likely outcome there.
Yeah, Stripe is definitely an outlier. I mean, they have such a powerful technology, and they just don't want to go public. We're seeing fewer and fewer companies opting to go public, especially over the last 2-3 years. That could be a mixture of like the macro environment within interest rates and like post-COVID and all that. But also, is it even really necessary with so much private money in the private equity space and venture capital world? We don't know.
Yeah.
We shall see. What's our next question, Mademoiselle?
Well, there's two that are pretty technical, and I think they're honestly kind of boring, but I'm going to ask you anyway. What is the sell to cover strategy, and how does it work? Incidentally, folks, if you are searching for brooklynfi.com, this is the number one search term that leads people to find our website. So my stupid blog post from 1 million years ago about sell to cover is one of our most read posts because people are wondering about this. They hear this, they hear their employee stock plan administrators talk about it. What does sell to cover actually mean?
Well, apparently I'm sitting with an expert. So why don't you cover the sell to cover?
So sell to cover, we're talking a lot about how when RSUs vest, there is tax immediately due. And it is very hard to convince your company and the US government that you'll take care of the taxes on that. No. The IRS is not okay with that explanation. So they demand the taxes right away. So the sell to cover strategy basically means when those RSUs vest, that you are going to elect to sell the exact right number of shares that are required to pay those taxes, both at the federal and state level. So if you had 10 shares vesting, you might end up only at the end of the day, after you've elected this sell to cover strategy, you might only end up with 7 shares because 3 were withheld and sold subsequently to then pay the taxes to New York State if you're here, and the IRS, aka the federal government. So sell to cover just means in most cases you have to sell to cover. I have seen situations, Shane, where you can get out of it if you make the tax payments by a certain date. You're kind of playing this game where you can kind of wait till the quarter and then you can make an estimated tax payment. I don't recommend that. I think it's too risky. And there are very few cases where that would make sense, in my opinion.
Yeah, 100%. 100%. You got me thinking about also it helps you diversify.
Yeah.
Right. Like 99% of the time, we're trying to get our clients to diversify out of the positions that they have at the companies that they're working at. Because if another investment advisor had walked up to one of these clients and said, "Hey, you've got a portfolio of 200,000. Let's invest 180,000 in one company. Let's do that." Like, no, we wouldn't do that, right? Well, what often happens is we have 90% concentration from these people because they work at these places. It's just another way to think about it. And we always want to diversify out of these highly concentrated positions.
And we're not anti-owning company stock. That's not what we're saying here. We're just saying if you already work at this company, you're probably going to get more grants there. Like, you're just going to continue to keep dipping into the pool. So like, if we have an opportunity to sell, let's sell some of it. Let's take some risk off the table. And yes, I always tell clients, like, I hope I'm wrong. I hope your company is the next Apple or the next Amazon. I really hope that for you. But sometimes, most of the time, your company's stock price wavers dramatically or it goes down. We have a lot of clients who went through IPOs in 2020 and 2021, and their stock price today in 2025 has still not eclipsed the original price that it was at IPO because it was, market analysts would say, it was overvalued, right? So that's a situation where if we had said sell it all on day one, quote, we would have been quote unquote right. Whereas if they decided to keep all of it, they missed out on potentially millions of dollars of quote unquote guaranteed income because we saw the price, we were able to sell it, pay the taxes, and move on with our lives. So that's why we're pretty gung-ho about diversification. We're not saying sell everything. We're saying come up with a number. I like to call it our legacy position. How much do we want to hold in this company long term, and adjust our quarterly sell-off strategy accordingly. Everything in moderation.
I love that. I'm feeling very inspired today, AJ. I love these answers. Yes, I love that. I have some ideas I want to discuss with you after the podcast.
Okay, great.
What's next? Should we talk about watch sales? How they can impact you? We'll do this quickly. Yeah.
Tell me about watch sales.
This one sucks. So no, it's intended actually. There's good intent here. So in order to prevent people from selling stock and then immediately buying it right back, so they get a tax loss on their tax return, but then they essentially still own the stock. IRS created these rules called wash sales, where like you are washing away the actual changes to your portfolio.
Wash, right?
Yeah, but you get the tax loss. So what they say is like, if you buy back a stock that you sold within the last 30-ish days, then you don't get to take that loss. Now, what can happen with our clients or really anyone within RSUs is that you might have sold your stock because we put together a diversification plan, but you have your stock at your company vesting within the next 30 days of that sale. Therefore, you have triggered this rule because when your stock vests, you've acquired it, and then you just have to watch out for this and work with an advisor to get the timing just right. Because if you're vesting on a monthly or quarterly basis, and then you've got blackout periods to worry about because you work at a public company, then you got to get real specific with your buys and sells at those companies. So just watch out for that.
Oh my God, we didn't even talk about blackout periods. Friday night was wild for me, honestly. Anyway. Sorry.
A rare drinking joke.
I got in trouble. Girl. I got in trouble, y'all.
Something happened?
No, I know. I just got in trouble for being too hungover on Saturday. I had a great time. No, it was
by the husband?
Yes, husband was not pleased with my performance of doing anything on Saturday. But I had a great time. It was a dear friend's 40th birthday party, karaoke. It was so much fun. So next, at a future episode, we'll cover blackout periods.
I saw you on your Do Your System of a Down routine on Instagram. You were killing it as usual.
Thank you. I don't really remember much of it, but it was great.
Well done. Life is meant for enjoying. So let's do that.
I agree.
Dear listener.
Let's wrap it up, Shane. I'm going to read us out. Thank you so much for listening. You can email us your financial problems at liquidityevent@brooklynfi.com. Leave us a voicemail, memo.fm/liquidityevent. We will play it on the air. You can also tag us on Instagram, do whatever you want. And finally, Stans can leave us a review if they want to be weird about it. I will see you next week. Shane, I will not see you next week. You will be traveling. So we will have Mr. John Owens in the co-hot seat. We'll see you then. Bye.
Bye.